I don't live in it. Sunshine gonna wash my blues away. Had sweet love, but I lost it. She got too close, so far, and now I'm lost in the world, trying to find me a better way. Wishing I was deep, deep in the water somewhere. Got the blue sky breeze, and it don't seem fair. Only worry in the world is the tide gonna reach my chair. Sunrise, there's a fire in the sky. Never been so happy, never felt so high. And I think I might have found me my own kind of paradise. Send me back.
Good morning. Happy Thursday. Okay. I don't know about you, I am loving this rain. If you're here in Texas, we are getting some rain. Prayers over Louisiana and everything going on there, but definitely enjoying the cooler weather. And actually, next week, I think it's supposed to be even cooler, and I'm very excited about that. I don't know about you. I was telling a dear friend of mine yesterday, and I'll be transparent, that it's been kind of rough going back to school, and it's been kind of crazy. I don't know. I've just felt off. The days have been kind of different. So, kind of getting into a new routine. And so, I am glad to be to Thursday. And I feel refreshed today. So, I am ready to hit this. We are in week 5 of LOANOPOLY. LOANOPOLY is where we're taking you through the mortgage buying process from cradle to grave, which is that pre-qualification, getting pre-approved. Then you're shopping for a house, you're getting your documents together, you've made a contract, you've gotten inspections, appraisals done. Our processing team at the mortgage unit has started your loan, and now we're going into a new department. So remember, processing is kind of your hub that is facilitating where it goes next. So the next place that it goes is to an underwriter. An underwriter's job is to analyze your loan or your customer's loan for credit risk. It's looking at the whole thing and saying, does this meet the GSE's requirements? GSE is your government sponsored enterprises. That is your Fannie, Freddie, FHA, VA. They give us a set of criteria that each consumer has to meet. So the underwriter's job is to look at those pieces. All of those entities have what is called typically the 4 pillars of credit, the 4 C's of a file. And it is credit, capacity, capital, and collateral. Okay, so let me break that down for you. If you are investing in the stock market and you're looking at what to invest in, you're looking at the history, the performance. You're going to see what that entity is doing and how well your money is going to yield on that investment. Okay, it's the same for a mortgage. You have to look at a consumer and say, is this consumer going to perform? Are they going to pay their bills? And so the 4 C's is kind of, if you were holding a steady house, if one of them was shaky, could the other pillars support it? So that's kind of what that is. So the first one is credit. The underwriter is making sure it meets the minimum credit standards for the investor. It's making sure that it's meeting, do they have mortgage lates? Do they have rent lates? What do the collections look like? Because remember, each of these entities have a set of criteria that we have to meet, that we have to make sure that the consumer falls into. So they're going to look at the credit, and they're going to look at the history of the credit. So there for a while, we talked about this early in the year, which was during COVID, they tightened those restrictions up. Credit score requirements got higher. Now they're back down. So they're going to look at those things and say, does it meet the minimum? Okay, the next one is capacity. Capacity is basically, can this person afford the house that they're buying? So a capacity is typically, you're going to hear it in mortgage terms referred to as a debt to income ratio or a housing ratio. That's basically the consumer's debt plus their future house payment divided by their income. It's just a ratio, it's a calculation. And so each of these investors has a specific amount of ratio that that person can have. So, for example, if you have a 620 credit score, your debt to income ratio may not exceed sometimes 45. Or if you have a 700 credit score, then your debt to income ratio can go up to 50. So, it's going to look at those different elements of credit risk. The third one is capital. Capital is how much money does this person have? Do they have enough for a down payment? Do they need down payment assistance? Where is that money coming from? And if something were to happen, are they supported? So that's capital. And then finally, it's collateral. Collateral is your property. Is the property actually worth what we're lending on? Is it marketable? So the underwriter's job is to look at those four pillars of credit based upon what the investors tell us and make sure it meets all their requirements. So the documentation that we get from you at the beginning and as we go through the process supports those four pieces, the four C's of credit. So we get your bank statements to make sure you have that capital. We get your pay stubs and W-2s, tax returns in some cases to make sure your income is supporting that. We pull your credit. We may ask for credit letters. We get an appraisal on your property. So all of those documents that we're asking for supports our credit risk of that file. Now, back in the day when I started, and that makes me sound old, back in the day. So back in the day, I started this, and you would typically, as an underwriter, you would make what's called a manual decision. A manual decision is me just looking at it and making a gut decision based upon what the investors tell me. And do I feel like I could support doing this loan based upon what I have in the file? Well, over the years, the investors, the GSEs came up with automated systems. It's just software. It's algorithm software that takes your data and analyzes it against the rules and says yes or no. Does it meet it or does it not? It's taken some of the pressure off of the underwriter to make a gut decision based upon what's in the file, and it's given a level playing field of the rules based upon what is given to it. The underwriter still has to come behind and make sure what was input into that software is actually accurate compared to the documents. And so sometimes, and I covered this in a prior live about underwriters, are they myth or urban legends? And they say, well, why does this underwriter keep asking me for things? I thought I already supplied that. And unfortunately, there are things that come up when underwriters look at your documents. One example that happens is if we get your bank statements and there's a large deposit on there that we don't know where it came from, and that's part of your capital, then that's got to say, where did that money come from? And we get more documents. If you have a tax return and you're self-employed and it's got multiple levels with K1s, we have to have all those supporting items. So there's things that sometimes don't get supplied that we do have to get. So that's kind of the underwriter's job. So they're going to look at this and, I'm going to use an example. I'm going to use income as an example. There are a multitude of different types of income. There is tips, hourly wages, bonus, Social Security, disability, child support, commissions. Everybody gets paid in a different way, and they have to be analyzed each differently because the GSEs look at us and they say, hey, based upon this type of income, this is how you have to document it, and this is how you have to calculate it. One of those things is self-employed. So I told you last week I would touch on that this week. I could spend a lot of time on self-employed. So I'm going to try to do a very high level job of that. The number one complaint I get from self-employed borrowers is, well, I make more than what I report. And hands down, you do. Your accountant does their job, which was to make sure all your expenses are in there and you're paying the least amount of taxes on that income that you make based on your expenses. So typically you're going to have a gross income of gross receipts and sales, and you're going to have a net. Fannie Mae, Freddie Mac, FHA, they all look at the self-employed borrowers very similar. They're going to take net and either add back or take away certain things based upon the parameters set in their guidelines. And the borrower says, but a lot of those write-offs are fluffed because we're trying to reduce our taxable income. I get it. Unfortunately, it helps you with taxes, but sometimes it can hinder you when you're buying a home. So, my advice to you is make sure you have a educated loan officer that can look at your tax returns and dig into them and understand the levels of self-employment that is there, because a lot of times there's stuff that we can add back, there is things that we can do and we can prove. For example, if it is a loss carryover, right, and or it's a one-time expense, or there's a lot of details when it comes to self-employed borrowers. So don't let that stop you, but be aware that it has nothing to do with the amount that you make. We know you make it. It's what we can prove. Now, take you to the next piece for self-employed borrowers. If you own your own business, there are also products out there for you. They're called bank statement products that we have at Loan Depot. So there are other ways to prove your income if you qualify under those parameters for that program. So again, I get a lot, it's probably twice a week I get self-employed borrowers, and I say, unfortunately, you're not showing any income, you're showing losses. And they say, yes, it's because of my write-offs. So it is very frustrating, but get with somebody, myself, someone that you know that is experienced in reviewing tax returns to help you through that. So that's what I'm going to say about tax returns. If you need more information, by all means, reach out to me and I'll be glad to help you through it. Or if you have a consumer that is struggling through that as well. Sometimes it's just understanding and knowing so they can make educated decisions versus not understanding what's happening to their loan. So the underwriter now has reviewed all of that information and they're going to make a decision based upon the automated system. They're going to make a decision based upon the criteria that's in there. And it's going to typically come out in three ways. The file's going to come back to that processor, that hub, and say the loan is either approved, fully approved, approved with conditions, suspended, or denied. Typically, 99% of the time, it's going to come out approved with conditions. That's normal. Typically, you're not going to have your appraisal back yet, or they need one additional pay stub, or they need proof that your earnest money has cleared your bank account. There are certain things that's going to come out, and the underwriter's going to ask for that. And so a lot of times customers go, oh no, it's not final approved. Well, no, it's approved with conditions. It means get me the last few little things, and then we'll final approve it. A suspended loan is a loan that the underwriter says, you know, we might be okay, but I need this to make a decision. I don't feel comfortable yet. It's not saying no, never. It's saying not yet. I just need these few things to make that decision. Then there is denied. Denied means it somehow did not meet the investor standards. I'm going to tell you, if you have a seasoned loan officer, a lot of times they can catch those things up front so they don't get down the road and find out that it doesn't meet the program requirements. It does happen, but very rarely if you find someone that can help you through that. And a lot of times it's researching up front if you have a unique situation. So that's kind of what's going to happen. Now, once that comes out, it's going to go back to your processing hub, your processor, who's going to take that and say, okay, we've got a approved with conditions, and I'm going to get back to you and collect what else we need. And your loan officer is going to help facilitate that. We gather those items, and then we get it back to the underwriter. So it's kind of that next step. So next week, we're going to talk about your title policy, your title company, what that means, what that looks like, what escrow means, and find out what that next stage is for title work and survey and those types of things. So I really appreciate you tuning in. If you have any questions, please reach out. Again, I'll post this one to my YouTube channel, and I look forward to seeing you next week. Y'all have a great day.